There is a type of person I meet all the time. They have been working for 5 years, 10 years, sometimes even 15 years. They are not reckless with money. They do not waste money on nonsense. Every month after getting paid, they try to put something aside. Maybe $2,000, maybe $5,000, maybe $20,000. Some people eventually save up $50,000, $100,000, or even more. From the outside, they look financially responsible. And they are. But there is one problem. Almost all of their money just sits in a bank account, year after year, and they strongly believe one thing: money in the bank is safe. Stocks? Too risky. ETFs? Too complicated. Investment funds? They are afraid of losing money. The market drops 10%? They cannot sleep. If that sounds like you, then this video is for you. I am not here to convince you to take all your savings and throw it into the stock market. That would be stupid. What I want to show you is how someone who is used to safety can slowly move from only saving to saving and investing without turning their financial life into a casino. And the first step is not opening a brokerage account. The first step is understanding what job your money is supposed to do. I want you to imagine your personal finances like a football team. A good team needs both defense and offense. Saving is defense. Its job is not to make you rich quickly. Its job is to stop you from getting destroyed financially. Next month's rent, food, medical bills, car repairs, money for emergencies, money you may need if you suddenly lose your job. This is money you need to access quickly. Now, investing is offense. You accept that your money may go up and down in the short term because you are aiming for long-term growth. These two tools have completely different jobs. The mistake many people make is asking one tool to do the job of the other. Using money you need in 6 months to buy stocks? Bad idea. But keeping money you will not need for 20 years in an account that barely grows? That can also be a problem. Because there is another enemy, an invisible one. It is called inflation. Imagine that today, $100 buys a certain basket of goods. A few years later, that same basket may cost $110, $120, or $130. The number in your bank account may not go down, but what that money can buy does. That is why I always make this distinction. Keeping your money is not the same as keeping its purchasing power, and this is where investing starts to matter. There is an interesting idea in behavioral finance. If someone loses $1,000, the pain they feel is often stronger than the happiness they feel from making $1,000. This is called loss aversion, and I see it clearly in people who have spent years saving. Let's say you have $20,000 in the bank. Every time you open your banking app, you see $20,000. You feel safe. Now you take $2,000 and invest it. 1 month later, it is worth $1,880. You are down $120 on paper, and immediately your mind starts talking. I knew it. Investing is dangerous. I should have just kept it in the bank. And many people sell right there. But the real problem is not that the portfolio dropped 6%. The real problem is that you were never mentally prepared for the fact that volatility is part of investing. A lot of people think in extremes. Saving equals complete safety. Investing equals gambling. No, gambling is putting money into something you do not understand, hoping it goes up fast, and praying. Real investing involves a goal, a time horizon, diversification, risk management, and discipline. Those are completely different things. So before you ask, what stock should I buy? Ask the more important question, is my financial foundation strong enough for me to invest? I like to think of money as water flowing through different levels. You do not pour water into the next level before the previous one is handled. Level 1. Build a starter emergency fund. Before thinking about making 10%, 15%, or 20% a year, make sure one small emergency does not destroy you. Maybe your car breaks down. Maybe you need medical treatment. Maybe your phone dies. Maybe an unexpected bill shows up. A good starting point might be around $1,000 to $2,000. The exact number depends on where you live and how much you spend. But the principle is simple. You need a small pile of cash that can absorb minor financial shocks without forcing you into high-interest debt or forcing you to sell investments. Level 2. Take full advantage of employer matching if available ever. If you live in a country where your employer matches retirement contributions, such as a 401k match in the United States, Understand how it works. For example, you contribute a certain percentage of your salary, and your employer adds money on top. If you qualify for that benefit and ignore it, you may be leaving valuable compensation on the table. If your country or employer does not offer anything like this, skip this step and move on. Level 3. Pay off high-interest debt. This is where many people do things backwards. They are carrying credit card debt at a very high interest rate, yet they are searching for an investment that might earn a few percent. That makes no sense. If your debt is costing you 8%, 15%, or 20% per year, paying it off gives you a guaranteed reduction in financial cost. A useful reference point is debt, with interest rates around 7 to 8% or higher. Not all debt is equal, but the principle is, before trying to grow your money, stop the obvious leaks. Level 4. Build a full emergency fund. Once dangerous debt is handled, build an emergency fund covering about 3 to 6 months of essential living expenses. I said essential expenses, not 3 to 6 months of income. Calculate the things that actually keep your life running. Housing, food, utilities, insurance, transportation, necessary obligations. Let's say your household needs at least $2,000 per month to function. 3 months means $6,000. 6 months means $12,000. Someone with a very stable job may choose the lower end. Someone who is self-employed, has unstable income, or supports an entire family may want a larger buffer. And the biggest value of this emergency fund is not the interest rate. The biggest value is that it prevents you from being forced to sell investments at the worst possible time. Imagine the market is down 25%. At the same time, you lose your job. Without an emergency fund, you may have no choice but to sell. But if you have 6 months of cash, you have time. You can handle real-life problems without destroying your long-term plan. That is the real value. This is a very simple mental trick, but I think it is extremely powerful for beginners. Do not look at all your money as one giant pile. Split it into 2 buckets. Bucket 1, safety, emergency money. Money you will need soon. Money for known obligations. The job of this bucket is stability and liquidity. Bucket 2, growth. This is money you do not need right now. You are giving this money enough time to survive market ups and downs. When those 2 buckets are separated, your emotions change. The market drops 15%, your family's food money is still safe. Your rent money is still there. Your emergency fund has not disappeared, so you are less likely to panic. This is another common misunderstanding. People say, I will start investing when I have more money. But for a beginner, the first goal is not even to make a lot of money. The first goal is to learn how to become an investor, and you can learn that skill with a small amount. Many platforms now offer fractional shares or small recurring investments. That lets beginners learn things like how orders work, how prices move, what it feels like when your portfolio goes up 5%, and more importantly, what it feels like when it goes down 5%. You can read 20 books about investing, but seeing $1,000 of your own money turn into $950 teaches you something very different. That is why I would rather see someone start small and learn properly than wait outside the market for 5 years, then suddenly throw all their savings in during a wave of excitement. Beginners often make another mistake. They open an account and suddenly buy everything. Some tech stocks, some bank stocks, a little crypto, 3 ETFs, 2 mutual funds, maybe gold. A month later, they have no idea what they actually own. Diversification does not mean buying as many things as possible. You can own 5 different funds and still have massive overlap between them. That is not true diversification. For beginners, simplicity has huge value. One common approach is using low-cost index funds or ETFs, such as funds that track a broad market index like the S&P 500. Instead of betting everything on one company, you own tiny pieces of many companies. That does not eliminate risk. The market can still drop hard, but it reduces the risk of being destroyed by one single company. If you want to experiment with individual stocks, a beginner may choose to focus on larger, established companies, often referred to as blue-chip stocks. But even then, do not buy a company just because you recognize the brand, and do not buy something because some guy on TikTok says it is going to explode next week. It is your money, so the responsibility has to be yours too. There is one question almost every beginner asks: is today a good time to buy? The market has already gone up a lot. They are afraid they are buying the top. Then the market drops. Now they are afraid it will drop even more. 6 months later, they still have not bought anything. One way to reduce this emotional problem is dollar cost averaging, or DCA. That simply means investing a fixed amount on a regular schedule. For example, every payday, you automatically invest $100. This month the market is high, you invest. Next month it is lower, you still invest. When prices are lower, the same amount buys more shares. When prices are higher, it buys fewer shares. The biggest thing I like about DCA is not that it is magical, it is that it reduces the number of decisions you have to make. The more decisions humans make, the more opportunities we have to destroy our own discipline. Today you read about a recession. You stop investing. Tomorrow the market jumps. You feel FOMO and double your investment. Next week it drops. You panic and sell. That is no longer a strategy. That is emotion controlling your account. Automation makes investing boring, and sometimes, boring is exactly what you need. Here is one line I want you to remember. Money you need in the next 3 to 5 years should not be treated the same way as money you will not need for 20 years. Let's say you plan to buy a house in 2 years. If you invest the entire down payment in highly volatile assets, you are putting your life goal in the hands of the market. What happens if the market drops 30% right when you need the money? Now compare that with money meant for 10, 20, or 30 years from now. That money has more time to go through market cycles. This is also where compound growth becomes powerful. Your returns generate more returns. Then those new returns generate even more returns. At first, the growth looks slow, but over long periods, the effect becomes much stronger. That is why one of the biggest advantages a young investor has is not necessarily a high salary. It is time. Trap number 1. Buying with greed and selling with fear. A stock keeps going up. Everyone online is talking about it. Your friends are bragging about profits. You cannot take it anymore. You buy. Then it drops. You panic. You sell. That is the classic formula. Buy high, sell low. It sounds stupid, but millions of people do it. Because when real money is involved, our emotions are much weaker than we like to believe. Trap number 2. Buying things you do not understand. Here is a simple rule. If you cannot explain in normal language what you own and how it creates value, be extremely careful. Do not invest just because someone said it could go up 5x. An insider told me. A private group said it is guaranteed. If your entire investment thesis only exists inside a Telegram group, that is not research. Trap number 3. Ignoring fees, 0.5%. 1%. It sounds tiny, but recurring fees over decades can take a meaningful portion of your returns. So when choosing an investment, do not only ask, how much did it make last year? Also look at management fees, trading fees, taxes, conversion costs, and any other costs connected to the account. Let's say you have $10,000 in cash, $15,000 in investments, $25,000 in retirement accounts, and $20,000 in debt. If you only open your brokerage app and see $15,000, you are looking at one tiny part of the picture. You need to look at everything. Assets, cash, investments, debt, retirement accounts. From there, calculate your net worth. Then you can start asking better questions. Am I holding too much cash? Am I overexposed to one type of investment? How much debt do I have relative to my assets? What level of risk am I actually taking? This is what it means to manage your finances as one complete portfolio. Do not let every account become its own isolated island, because in the end, all of your money serves one life, your life. If investing still feels complicated, let me reduce this entire video into one simple roadmap. First, do not invest money you will need soon. Second, build a starter emergency fund. If your employer offers a matching retirement contribution, learn how to use it. Then attack high-interest debt. After that, build a full emergency fund of around 3 to 6 months of essential expenses. Then separate long-term money for investing. Start small. Prefer things you understand. Keep your portfolio simple. Diversify intelligently. Automate regular investing if it makes sense for you. And most importantly, give the plan enough time to work. You do not need to become Warren Buffett next week. You do not need to wake up at 6 a.m. every morning and read the financial reports of 300 companies. Beginners do not lose because they do not know enough complicated terms. A lot of people lose because they do not have a system. Today, one person tells them to buy this. Tomorrow, someone else tells them to sell that. The market goes up, they get greedy. The market goes down, they get scared. In the end, it is their money, but someone else's mouth and their own emotions are making the decisions. Do not do that. Saving helped you build the foundation. Do not treat saving like something outdated, but do not turn safety into an excuse to leave your money sitting still for decades without ever learning what comes next. The goal is not to turn a cautious saver into a gambler. The goal is to become someone who clearly understands which money needs to be protected, which money can be used for growth, how much risk you are willing to accept, and what goal you are investing for. Once you can answer those 4 questions, investing becomes less frightening. It becomes a tool, and in the end, money is just a tool to help you build a better life. This content is for educational purposes only and should not be considered personalized financial advice or a recommendation to buy or sell any specific investment product. Everyone has different income, obligations, risk tolerance, tax situations, and financial goals, so make sure you do your own research or speak with a qualified financial professional before making major financial decisions.